All right, ladies and gentlemen, I hope you had a wonderful day. It was quite the wild day in the market today. We had Nvidia after the bell, but leading into it, the minutes gave us a surprisingly hawkish reaction, and then we pretty much closed right where it came out. And then after the bell, Nvidia saved the market. Their earnings killed it on the top and bottom line, and then they announced a 10-for-1 stock split as well as raising their dividend. But now, you may have heard me say this in the past, so-and-so saved the market, yibbity-bobbity-boo. Well, this time, why Nvidia was so important and everybody was going crazy, because ahead of this event, JP Morgan, they were saying that Nvidia's report is a bellwether for AI in the market, and if they did bad, they would have seen that as recessionary and stagflationary. So the fact that they came out after the bell, they killed it on this earnings. They beat the expectations. They raised their expectations higher than the average analyst estimate for next quarter, and that's big because the last couple of quarters they weren't doing that. They would come out with guidance and it would be just under what the bullish analysts were expecting, and now this time it finally came in above, and then obviously the stock split is driving it home. So the conference call, it is already wrapped up. Jensen said a couple of things. We'll talk about it. He did mention China kind of negatively. Other than that, though, the market loved it, and it seems like everybody is collectively letting out a sigh of relief, and then the bulls are like, wow, and shout out if you got it, bro. If you got this in the long term, you get that split, make the money off the buy longer, you're holding less risk, here it comes. Good work, baby. But that is what we have to talk about. I have the keys, I have the plays, I have the questions, and then I have a good lesson for you. And we did make a lot of plays today. So, Chad, what I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Walking to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like it's a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, it's pretty straightforward. Nvidia was good. That is going to be a green light for some period of tomorrow and maybe for the next couple of weeks. Now, here's the bad part. You can't go too crazy, and why I say that, because the minutes today was surprisingly hawkish. Why I say surprisingly hawkish, it's not as if anybody was expecting a dovish minutes. It came out and it was saying things we should have been expecting. There was a couple of things related to financial conditions, and that was kind of new, but the reaction was pretty big. Now, like I already showed you, you do pull it out. You ended up right where you were when it all happened. We're still holding 5,300. We're like 25 points away from the all-time highs, but by looking at that reaction and kind of seeing how we hesitated, and then we'll see how everybody takes this tomorrow now that we're feeling good about AI. And again, NVIDIA growing at the pace they are, that's a really good sign, or at the very least individually, that's huge, to the point some of y'all are even saying it's fraud. It's fraud. So we'll find out, but there is a couple of things still holding us back. You would think with how optimistic people are, the fact that you have a lot of the risk priced in, yeah, we just hit a new all-time high, but dude, a couple of weeks ago, a couple months ago, you were ripping a couple hundred points off of way less data and confirmation, and we're not moving as fast here, and I think that has to do with some of these reactions and a couple of the big data sets coming in a few weeks, and then that low liquidity. So for now, Nvidia is a good sign. It should clear the way, but not too fast, buddy. But that is key number one. Key number two, since there's not much to deal with and moving forward, we got to be able to see how we digest what just happened here. The thing I want to mention is that, one, Japan rates right now have finally gone above 1%. That's their first time since 2013. It says first time. First time since 2013, about what, 11 years ago? And then the election announcement in the UK today, people were talking about that moving the pound. And then on top of it, gold was the real victim today and sold off like 2%. It was the worst day since April when it started going crazy with some of those other central bank actions. Now, why I'm bringing this up, because we have some other global currency stuff kind of playing out right now. And low key, I don't know if you guys realize it with some of the headlines, before you know it, this election stuff is going to be heating up. We've been getting the whack-a-mole or pandering, whatever you want to call it. We've been seeing some of that, but that will also start heating up too. But for now, low liquidity. We're riding the wave off the earnings. Earnings season is pretty much over. I'd keep in mind now if currencies start to make a move. Otherwise, keep watching bonds and then keep watching equities. So that is key number 2. And then finally, coming into tomorrow, we have the PMI and the jobless claims. I'm not expecting much. However, after today's reaction on the minutes, just be prepared, and I would watch too if bonds move more than equities or if equities move more than bonds, because equities have a little bit more room to run or run up or down, and mostly down probably because the bonds are still at 4 or 5. That hasn't really changed since around CPI, and imagine how much we were talking about that. But other than that data, we're going to have a little bit more on Friday. I think durable goods or consumer sentiment. Consumer sentiment, I say that right? But other than that, man, I think it's going to be a gigantic punt over the next couple of weeks until we get into bigger CPI data June 12th. And then before you know, it'll be the SCP. In the meantime, we did one of the plays today. Maybe we just strap in and sell premium or collect your yields. Maybe go long-term shopping and see what you can find. But I hope you're ready either way, and we'll be there. I got your back, baby. But now, let us get into the plays. So, right off the bat, you know what I'm going to start with, NVIDIA, man. So, a question today. I could have added it to the questions, but somebody asked in the chat. Shout out Crystal. She asked, what happens with this split? So what happens to your options? So NVIDIA is splitting 10 for 1. If you own 10 shares of NVIDIA right now, I believe it's like June 7th or June 12th. You could go look up the dates for all of it, but they will split 10 to 1 or 1 to 10. Point is, your 10 shares will turn into 100 shares. And now as far as options, it's exactly the same thing. It's just literally divide everything by the 10 or multiple by 10, and that is going to get you your answer. So your shares are going to go up by 10 times the amount. The value will stay the same. So you're going to get 10 times as many shares that are worth a tenth of the value of the stock. So thank God the stock is at $1,000, because if the stock is at $1,000, you have 1 share, your 1 share will turn into 10. Or if you have 10 shares, or 10 shares will turn into 100. And same thing, the dividend and all of that will adjust. And it literally works the exact same way for your option. So what's going to happen to your option? You are going to get 10 options that'll be equivalent of the price of your current strike price, and they will be worth a tenth of the value. So nothing really changes. The only real benefit you get out of this is now you just have more quantity. If you think about it, you only had one option. You had to either ghetto spread or take profits. Now you could just kind of maneuver in and out of it, but everything will stay relative value the same, and then it's going to get moved by a factor of 10. So good luck, and I'm glad that you guys got it. As far as my play, though, I'm just going to be playing the split hype. Once again, I did go for a play after earnings. I grabbed 10 shares at like $9.87. I'm going to flip that. It's not for the long term. I do want to hold it till we get close to that record date, because a lot of the tech splits, they do go nuts. We did talk about Walmart recently. They just had a split. It didn't go too nuts. Chipotle, it's a restaurant. They did go crazy, but they gave a big lead time, so they already had like multiple earnings. So it could go either direction, but I just like the report. However, we played NVIDIA reports a lot of times right now, and honestly, it could go either way. So I'm liking the play for now. We'll see. I did not like the comments from the CEO. He was talking about the China demand and it not being as high as what they've seen in the past. It did kind of slow the stock down a little bit, but it's still holding above 1,000 there. So we'll see how it plays out. I'll be writing my 10 shares. That is play number 1. Then play number 2. Gold, baby. We'll go over the exact play and you'll see what I did, but I got back into it and I'm starting with it small. So I'm going to keep watching because I think it might go down a little lower. My target was about $10 higher than where I grabbed it today. But remember, it was a couple weeks ago. I was like, I was kicking rocks, the can, whatever you want to call it. But we had an opportunity to get it, and then it ran up like another $100. It came down today, surprisingly, off of the minutes, and that it was already down before, but all of it was borderline surprising considering a lot of this commodity rally that we saw. But I saw it as a good chance to get in, but the pricing is always the issue, so I made sure I kept it small. So little by little, I'm going to try to work my way into a decent position until I could flip out of it on the next central bank move. So watch out for that. That is play number 2. And then finally, Pfizer. Oh, yeah. So, yes, I have it in the long term. It's actually gone green for us. Good, nice rally, man, and we had a good dip buy about a month or two ago, but people kept bringing up the options today and how cheap they are, and they're cheap because Pfizer barely moves. It's a small $20 stock. I mean, 100% takes it up to like $50. It doesn't really move like that, and even though people think it's really awful right now, just go look at their market cap. It is still a very large company, but with that being said now, there's this new bird flu hype. People are talking about other sicknesses, and then there was something about Pfizer and Myrna and the government related to the bird flu today, and we got to hear a little bit about that. So I would just watch if you get any of that hype playing into these type of stocks, and if it does start running abnormally because of an outsized event, those options are going to be really, really cheap. So keep your eyes out for it. I don't have a play on the options, only long term. There is my bias, and yeah, we'll see what happens, but those are the main plays. As far as everything else, I was going to add DuPont. They had big news after the bell if you were there, and the news was related to them spinning off, so watch out for that. But other than those plays, what I did, my first play today, I grabbed a next week target. Again, they did bad. They sold off, and I was like, all right, maybe I'll play the opposite move, and I wanted to keep it small. Again, these options this earnings season, they have not hit at all when it comes down to the earnings, 2 standard deviations, even the post plays. Again, low liquidity and how it's moved, it's not been there, man. They gave us a quarter, not this quarter, but I did go for the play, and I kept it small, literally $9, 157.5 call. I was up like 40% at one point. It went up to like 18, 20 cents. So we'll write it out just in case you could get some of the upside, and maybe Nvidia will spark it, but no guarantees on that. But that was the first play. Then the second play, I did it after the minutes. It started dumping. It was down like 2%. I said, hey, it's like $10 higher than the 23.76 I wanted. So I said, let me just grab it here. But I went small. MGC, it did flush even after I bought it. And I was giving you guys updates throughout the trading day. But the thing about it, even at like a low, I think I'm like another couple dollars lower, I was only down like $70. You've seen me trade this a lot bigger, and the movements are crazier. But with one MGC, I mean, it's still a big, depending on the size of your account. But like even now, I guess I'm down like almost $4 on my position, and I'm down literally $30. So like I said, keeping it small. We talked about how key positioning is gold, so don't want to go too big unless we get like a really, really big discount. So we'll see how that plays out. But that was the second play, and then finally the MNQ, I grabbed one at 18,702.25. I'm up on it now. It's actually doing good with the Nvidia, and I just played it after the minutes because we just started dumping. I did not think that the minutes would bring us down like that, and we started to go and overshoot a little bit. We had Nvidia earnings coming up. I said, hey, I'm down to go with one MNQ. That would move way bigger than one of the MGCs, so they are not the same in terms of sizing. Why? Because look how much bigger $18,000 is versus $2,300. That's why. So I decided to go for that, and it ended up working out. Got a bottom tick. I'm going to be writing that out. Maybe I'll balance that between the Nvidia. It's kind of like a pseudo Nvidia. We'll see how it plays, but still holding. Got a good gain on that. I think I'm up like 300 or 400, or I was up 400 at the peak of like the Nvidia pop, but then it was like mostly like I think like 280, $300 on that. So not too bad, but that was everything. We'll see what tomorrow morning brings. And again, be there in the AM, man. We go over all the plays around the world every morning, baby. It's amazing. But getting into the questions now, I love it. And honestly, I think it's a good question. This was asked the other day, and I had the good opportunity to get it in here today, and I like it. I think it's good. And they said, Josh, or they said question. They didn't say Josh. Why gold stocks don't go up as gold goes. I know exactly what you mean, bro, and I think a lot of you know this, and I love this question because I really hope you all understand this. But as you ask that question, let me ask you another couple of questions. Why do you have potholes even though you pay way more in taxes? Why does it feel that there is more evil in the world every single day, but there's record highs of tithing and money given to the churches, and then there's homeless people, even though there's all this tithing? Why does oil keep trading relatively the same? Oh, man, I'm getting hyped. I'm hitting my keyboard. It trades relatively the same, but you have these big sanctions and energy shifts and all of that, and sanctions on Russia. Why? So the answer to all of these, and even the gold, is humans. A human spent your tax dollars on something else. They didn't fix what you wanted. A pastor bought a jet instead of feeding and giving to the people. Humans circumvented the sanctions, and the Russian oil went to India, and they just bought it from India. Nothing changed. So when it comes to the price of gold and gold stocks, they do not correlate because humans run these companies, and it's sad. I trust me, because like I've learned this a long time ago, but I do think this is a crash course everybody has to get, and I strongly suggest that you avoid the gold miners. Why? Because you are way better off owning the commodity. If the manager of that gold company or it has debt and it doesn't perform and optimize with what the environment is doing, sometimes higher prices can hurt them, or they just do not benefit the same, or they want to raise money and capital. Think about it. It's a company. It's different than the actual commodity. And I want you to think about this. With every commodity, there is the commodity itself. There's oil, and then there's oil companies. There's gold, and then there's gold companies. There's agriculture, and then there's agriculture companies, food companies, right? So if you want to go for the commodity, I strongly suggest that you just go after the company. It's safer, easier, and usually more profitable. If you think gold is going to outperform, just buy the gold. And I have it written here, and here's the thing. What I'm saying is not absolute. There are some good stewards out there, not steward MPW. That's ironic, right? But I mean like people who are in these companies and manage it well. That's why at some point last year when oil was dropping substantially, your XOMs didn't drop like that. There is good managers out there, few and far between, but in the meantime, unless you know and believe that the asset itself, the commodity, and the manager is going to be good, you're better off just going for the commodity. So, like I've said it for a while. Even own the physical gold. You already know what I'm doing, man. Own the physical gold. Yeah, so you can't do that with the shares, And again, if you buy gold on paper, you're buying, I own, gold futures or whatever. That there's always a difference between that and physical. So, yeah. I hope that helps, man. Great question. And now to question number 2. I love this, man. Shout out to Braxton, baby. Can you talk about China and dumping bonds and the correlation with markets? I know, China. We could talk about China. I could talk about this, but sadly, it'll end in Japan. I don't know why I think it's the China, but here's the deal. The conversation will end in Japan. It's kind of funny, but I'm sure some of you remember this, or maybe take a look back. China used to be our biggest debt holder of bonds. Some of you may still think that they are, but people used to trip out about this. I think there's plots of movies, and they're like, China will dump the bonds, and if the China bond, I'm sure a bunch of YouTube videos back in the day on this, but this whole they're going to dump our bonds and all that, low-key, it's already occurred. And believe it or not, Japan is the number 1 holder of our bonds now. So China is number 2. It is still a big amount, but I wouldn't really be too worried about that until there's more bigger escalations between U.S.-China relations, or until their economic situation spirals out of control or recovers. But here's the deal. It'll get to one of our economic lessons. The irony of all of this is that they have to own our debt. I mean, one, reserve currency and all that, but we're going to get into a lesson on balance of payments and trade. And quite simply, we cannot buy their trade goods, and they need us to if their economy is struggling. We can't buy those trade goods if they don't fund with our capital, or they fund their capital. They give us the debt. They give us the capital account. We help them out on the trade account. Welcome to globalization, baby. So that's the first part. And like I'm saying, it ends with Japan, because right now, Japan is the number 1 holder of our debt. That is who you should be worried about. Those are the people that if they sell, we got a really big problem. And then on top of that, think about it. They have to normalize, and they're trying to do this whole thing with their inflation. If they need to tap into that, our bonds, and start changing things around, and then that starts moving, and then you start to think about the carry trade and the feedback loop between the dollar and the yen, that is where things really get crazy. So China dumping our bonds, it's one thing, but it's not as important right now until trade relations, or you have a clearer cut path on their economic recovery, because again, they need us for trade. This is my opinion too. I should probably add, and I'm sure, everybody could argue about this, and we won't really know the fact until you got to talk to Winnie. I mean, yeah, you know what I'm saying? So, but other than that, Japan, though, I do think is the major issue. And then again, maybe I have to give you the follow-up. Someone's going to have with a carry trade. We could talk about that. We have in the past, but even then, just don't forget about the bonds. And, a lot of people, myself included, we talk about the yen a lot, but the Japanese bonds are key. And that's why I mentioned it up above here today. It is very important. And if those yields of Japanese yields change, and then people are now, again, if those yields in Japan go up and then you be holding American debt, why would you hold the American debt? And there's a lot of things, or if they need that, and now think bond liquidity, we're trying to fund wars and all this stuff. I mean, who can we afford? Can we afford more China dump or Japan dump? I mean, that's where we start asking a lot more questions, but maybe I'll get you a follow-up on that. Great question, but now, are you guys ready? Oh, I don't even write out the thing. Are you guys ready for lesson number 2? So here is the deal. I'm very excited about this. We got a great lesson today on hegemonies and shifts. And I think it's actually, we're going to talk trade rising and trade collapses. And I'm going to be giving you guys, we're going to start bundling this up. We're going through a couple of these chapters, but I'm going to give you some breakdowns. I might give you a quiz. Don't worry, I won't ban you if you fail. Maybe. I didn't think maybe. I'm just playing with you. But here's the deal. These are long, and I'm going into it. And you guys, I'm really grateful, and I hope you enjoy it as well, too. You guys are loving this, and I love doing it, and I think some of you are just realizing there's a lot of info out there, and you can learn a lot more, and there's a different level to understanding some of this stuff. But I want to make sure it doesn't get lost in the abyss of thousands and thousands of videos we've been doing for years, baby. So I have this lesson, Econ Lessons 2024. It's going to start with our first one. The second one, it was around here we started going in order, but it's going to update. The last one will be the recent one. The first one will be the first lesson, but then that way you'll have all of this, and then I do plan on giving you guys kind of a more comprehensive follow-up as we start moving through the blocks and chapters. And then once we set the foundation, my plan is to start applying this with my context to more of a trading background in economics. So it's going to be fun, man, but I'm glad y'all are with me. And again, I just think hopefully you could sharpen your tools and hone your craft in by getting some of this information. And I truly do hope it helps. So let us begin, baby. It's a great lesson here today. We are going to be talking about hegemons, public goods, and the world trade system. The stability of the WTO and of international trade systems more broadly is a function of the distribution of power in the international system. In particularly, hegemonic stability theory is often advanced to explain why the system shifts between periods in which it is open and liberal and periods in which it is closed and discriminatory. Hegemonic stability theory rests on the logic of public goods provision. A public good is defined by two characteristics: non-excludability and non-rivalry. Non-excludability means that once the good has been supplied, no one can be prevented from enjoying its benefits. A lighthouse, for example, warns captains away from a nearby coast. Once that beacon is lit, no captain can be prevented from observing the light and avoiding the coast. Non-rivalry means that the consumption by one individual does not diminish the quantity of the goods available to others. No matter how many captains have already consumed the light, it remains just as visible to the next captain. Public goods tend to be undersupplied relative to the value society places upon them. Undersupply is a result of a phenomena called free riding. Free riding describes situations in which many individuals rely on others to pay for a public good. My experience with public radio illustrates the logic. My local public radio station uses voluntary contributions from its listeners and businesses to finance 87% of its budget. Without these voluntary contributions, the station would go off the air. As a regular listener, I benefit immensely from the station's existence, and my life would be greatly diminished were the station to shut down. Yet, I have never contributed to the station. Instead, I rely upon others to pay for the station's operations. In other words, I free ride on other listeners' contributions because everyone faces the same incentive structure. Contributions to the station are lower than they would be if non-contributors could be denied access to the public radio. More broadly, goods that are non-excludable and non-rivalrous tend to be undersupplied. So, you may be thinking about the stream. I love you, but here's the deal. This is huge, and I'm glad it's going to take, this is my opinion, obviously, since I'm interrupting and not reading, but the thing about this is going to be something that's going to come up a lot, understanding the logic of the free rider theory and public goods and how it's utilized. This will come up even beyond your learning in this. You could apply this to a lot of other areas in political science and just even throughout, but the economic trend and connection, that's what we're going to focus on. But I'm telling you, understand this, because this is something, no matter what in the world, it's a fact of how things operate, and it explains it, but you do want to be familiar with this. So moving forward, the severity of the free riding problem is partly a function of the size of the group. In large groups, each individual contribution is very small relative to the total contribution, and as a result, each individual has only a small impact on the ability of the group to achieve its objective. Consequently, each individual readily concludes that the group can succeed without his contribution. In large groups, therefore, the incentive to free ride is very strong. In small groups, sometimes called privileged groups, each individual contribution is large relative to the total contribution, and therefore each contribution has a greater impact on the group's ability to achieve its common goal. It becomes more difficult for any individual to conclude that the group can succeed without his contribution. As a result, the incentive to free ride is weaker, though not altogether absent in small groups. International institutions such as the WTO have public good characteristics. International rules and procedures benefit all governments, though not necessarily all benefit equally. Moreover, it's difficult, though not impossible, to deny a government these benefits once an institution has been established. Moreover, these benefits do not decrease as a function of the number of governments that belong to the institution. Because international institutions have these public good characteristics, their provisions can be frustrated by free riding. All governments want global trade rules, but each wants someone else to bear the cost of providing such rules. Again, costs. Who bears them? Who's willing to? This is where that's pure economics and rationality, but it's key here because, again, you guys are now know the framework and the WTO, and that's what we're talking about, but how it's linking to answer some of those previous questions. Continuing. Hegemonic stability theory argues that hegemons act like privileged groups and thus overcome the free riding problem. A hegemon is a country, I'm saying it like Pokemon, so I don't know, y'all tell me, that produces a disproportionately large share of the world's total output and that leads in the development of new technologies. Because it is so large and technologically advanced, the benefits that the hegemon gains from trade are so large that it's willing to bear the full cost of creating international trade rules. Moreover, the hegemon recognizes that the public good will not be provided in the absence of its contribution. Hence, the free riding problem largely disappears and stable regimes are established during periods of hegemonic leadership. As a hegemon declines in power, it becomes less willing to bear the cost of maintaining trade rules and world trade becomes less open. Historical evidence provides some support for hegemonic stability theory, as world trade has flourished during periods of hegemonic leadership and floundered during periods without it. The two periods of rapid growth of world trade occurred under periods of clear hegemony. Great Britain, by far the world's largest and most innovative economy throughout the 19th century, trade within Europe and between Europe and the rest of the world grew at what were then unprecedented rates. British hegemony therefore created and sustained an open, liberal, and highly stable global economy in which goods, capital, and labor flowed freely across borders. This same relationship is evident in the 20th century. The United States exited World War II, and as an undisputed Pokemon, it played the leading role in creating the GATT, and it led the push for negotiations that progressively eliminated barriers to trade. The result was the most rapid increase in world trade in history. Hence, the two hegemonic eras are characterized by stable trade regimes and the rapid growth of international trade. The one instance of hegemonic transition is associated with the collapse of the world trade system. The transition from British to American hegemony occurred in the early 20th century. In 1820, American economy was only one-third the size of Great Britain. By 1870, the two economies were roughly the same size. On the eve of World War I, the American economy was more than twice as large as Great Britain. By the end of World War II, the United States produced almost half of the world's manufactured goods. During this transition, each looked to the other to bear the cost of restructuring the global economy after World War I, and the British tried to reconstruct the world economy in late 1920s, but lacked the resources to do so. The United States had the ability to reestablish a liberal world economy, but wasn't willing to expend the necessary resources. Consequently, the Great Depression sparked the profusion of discriminatory and protectionist trade blocs. As protectionism rose, world trade fell sharply. Hence, hegemonic transition has been associated with considerable instability of international trade. So there's a lot I could say on this one, but quite simply, I really hope you guys are drawing the connections of the time frame and understanding how so many things linked to get us to this modern era of finance. But think about it. It's not that modern when you really go look. We're still on some of these old systems. But here's one thing, man. You know, you're looking for volatility and instability. You can look for it in many ways in the market, but I mean, this is something to keep in mind on a very macro trend. But again, this doesn't occur all too often. Maybe we may or may not see this happen again in our lifetime. So that is something very interesting. But moving forward, although these episodes are suggestive, there are too few to support strong conclusions about the relationship between hegemony and international trade. The empirical limitation is of more than pure academic interest, given the emergence of China and India as powerful forces in the global economy. China's emergence in particular raises questions about whether we are witnessing a hegemonic transition. Goldman Sachs estimates that China will overtake the United States in total economic production by 2027. Christopher Lane asserts that economically, it is already doubtful that the United States is still a hegemon. China's rapid ascension to global economic power, in conjunction with the more nationalist policies of current President Xi Jinping, have pushed relations between China and the West toward greater competition and less cooperation. To date, however, China has yet to assert strong leadership in the existing WTO-centered trade system or push for alternative systems. So this is one thing I'll tell you. This is modern. Again, even India, and quite frankly, these history books will start giving India more attention. But when I was reading this in college, it did not talk. It talked about China and how it saved us from like the Great Recession and all of that in '08. But it's definitely taking on a different tone here in the updated version. And like it's saying, is this a hegemonic shift? How does it stack up against the U.S.? And then if you are familiar, you watch the watch list. I mean, look at China's economy right now. I mean, that is something you got to also think about. So very interesting. But moving on, these contemporary developments find parallels in the recent past. During the 1960s, the Japanese economy grew at an average annual rate of more than 10%, compared with the average growth rate of less than 4% for the United States. Although Japanese growth slowed during the 70s and 80s, Japan continued to grow more rapidly than the United States. Faster growth allowed Japan, and hopefully you enjoyed the Japan lesson, to catch up to the United States. In the early 1960s, the United States produced 40% of the world's manufactured goods, whereas Japan only produced 5.5%. In 1987, the United States' share of world manufacturing production had fell to 24%, whereas Japan's share had increased to 19.4%. In less than 30 years, therefore, Japan transformed itself from a vanquished nation into a powerful force in the world economy. Many commentators at the time viewed Japan's ascent as a harbinger of hegemonic decline. The United States began running trade deficits in the 70s, and these deficits continued to grow in the 80s. American policymakers interpreted these deficits as evidence of declining competitiveness, particularly in high-tech industries. Measures of the United States' comparative advantage in high-tech industries suggested that it was losing ground in critical sectors such as mechanical equipment, electronics, scientific instruments, and commercial aircraft. And what the United States appeared to be losing, Japan appeared to be gaining. Statistics suggested that as the American share of global high-tech markets fell from 30 to 21 from 1970 to 1989, Japan's share of this market rose from 7 to 16 in the same period. Thus, the trade deficit and the apparent decline in the American high-tech industries both pointed to the same conclusion. The United States was losing ground to Japan. The United States responded to these developments by adopting a more aggressive and protectionist trade policy. It increasingly relied on bilateral initiatives and threatened to protect the American market to force changes in other countries' trade policies. Japan was the principal, though not the sole, target of America's assertiveness. Many analysts argued that this assertiveness reflected the syndrome of hegemonic decline. Some argued that the protectionist tendencies generated by hegemonic decline would be reinforced by the end of the Cold War, which deprived the United States of a broader purpose provided by the alliance against the Soviet threat. Robert Gilpin, a political economist at Princeton, summarized the pessimistic outlook, arguing that at the opening of the 21st century, all the elements that have supported an open global economy have weakened. Assertions of hegemonic decline proved premature, however. American unilateralism subsided in the mid-1990s as the United States entered a period of sustained robust growth, and Japan struggled to recover from a financial and banking crisis. In this decade, governments strengthened and extended the multilateral trade system. They established the WTO, which enjoyed greater support and attracted a larger membership than the GATT did at the height of the American hegemony. As one analyst concluded in looking back on the predictions of hegemonic decline, the institutions that took hold after World War II continue to provide governance now, and the economic interest and political consensus that lie behind them are more, not less, supportive of an open world economy today than during the Cold War. That's what he was talking crap about Princeton, homie. The open question, therefore, is whether China's emergence today constitutes a hegemonic transition like the decline of the British hegemony in the early 20th century, or instead a false alarm triggered by Japan. That is the global system transitioning from the American century to the Asian century, or will Asia's ascent level off? Moreover, if we are experiencing a hegemonic transition, must the global trade system weaken and collapse as it did in the 1920s and 30s? Might the institutional structures built under American leadership help governments transition to a new global power structure without suffering another economic dark age? Wow. So, Chad, that is all I have. I've given you my interruption, but I don't know. I hope it interests you. I mean, I hope these lessons don't make you bearish, because these are all the macro, but hopefully you see some of the connections, man. This is why I've always loved this stuff. So, Chad, I hope you enjoyed it. If you have any questions, let me know, and get ready. We got a lot, but I think that was a good one. But that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, you want to get out of this cycle, stop making new rules for yourself. There's rules. Make them effective. You got principles that are effective, but if you keep subverting them. So, Chad, I love you. Drink that water. Stay hydrated and healthy. I'll see you in the morning. And